What it says is gold is no longer going to go mealy mouthed sideways versus the S&P, meaning just as good. It's blowing out of the 11-year wide base. Now,
That's exciting. Go ahead.
yeah, if I dropped this chart in front of you and didn't have a label on it and just said this is stock ABC, what would you say? You'd say, "Hey, I got to buy that guy. He's
Yeah, it
bringing."
just broke out.
Yeah. Okay. That means it just began. Okay. This is what just began. Everybody's thinking about gold is so old. It's overbought, silver, et cetera, et cetera. It just began, folks. The relative asset class shift out of the paper US stock market bubble has only just begun to move heartily into gold. Yeah, since 2024, that last low, gold's been advancing nicely but within that basing range. So this is a new game. That's what it tells you. It says, wake up. This is not an old trend in gold. This is brand new. The money flow is just beginning. Okay. So it's a table pounder.
Yeah,
Okay.
let me interrupt you here. And you said a keyword money flow. I was going to ask you about money flow and about this chart. I wanted you to answer, but you already answered it. Talk a little bit more about money flow, why that is important in this breakout, if you would.
Well, whenever the stock market has had a bear over the last 25, 30 years, going back 50 years, in fact, remember the 73, 74 bear in the stock market was a huge collapse. During that same time, gold was going from $30 to 200. Okay. So, opposites. Then you go to the dot-com top to the 2002 low. 82% collapse in NASDAQ, 150% in the S&P, yet gold was rising during that time. In fact, kept going for another till 2011. Then the 2007 top, mortgage top for the stock market. Didn't really pick up steam till eight, but between 2007 and 2009, the S&P got cut in half, and gold was rising. Yeah, there were jiggles in there, big ones sometimes, but basically in a major uptrend. So the money goes somewhere when it leaves the stock market. And where does it go? Well, we all know. Well, it was either Chase or one of the big banks anyway, Morgan Stanley maybe, made a statement about the 60-40 rule.
Mhm.
60% stocks, 40% T-bonds. Okay. That's the good, stable portfolio. Okay. Well, admittedly, during the 2000, 2002 bear in the stock market, 2007 and 9, if you own T-bonds, they went up. Yields went down. Okay. So it
Right.
was an alternative to some extent. Gold was a better alternative, but T-bonds and gold were competing as places to be other than the stock market. Now, that ain't the case, guys. You got the T-bonds right now starting to break some things that if you drop about another 4 points in T-bond futures, right now they're 115 and a half. You get down to about 111 and a half, you're going to have a panic in the government T-bond market that even the Fed is going to have to step into. And they've already hinted they might be doing that soon, buying T-bonds. That's not an alternative. So if you're getting out of the stock market, like one of the big banks just said, hey, it's better now to have a 60-20-20. Okay. Now, my argument would be, how about 60% gold, 20? Okay. Anyway, but it's at least it's a realization on the
Yes.
part of big bank, part of the Fed system, that, has gold really, I guess we got to admit, otherwise we look like fools. Uh, this chart says, watch out. It's going to
Yeah.
dominate when the flow comes out of the paper bubble, it's going to go here because T-bonds aren't acting well, and it looks like they're going to cause some pain and maybe even some headlines for the stock market of the negative kind. All
Yeah.
righty. Anyway,
So, anyway, so people are tuning in to listen to you, not listen to me. So I want to keep this brief, but to all my viewers and listeners here, Michael is a trader, and is currently trading and traded a lot in a previous life before this. And he just brought up something huge that a lot of people get, especially novice traders, don't get, or novice investors don't get, is just the idea of money flow. One asset's going down, it's typically reallocated to another asset that's breaking out. Correct me if I'm
mhm,
wrong, Michael. And that's what we're seeing right
mhm.
here. It also goes with our thesis, or Michael's thesis. Now he's sharing that thesis that gold is going to continue to go up. If you would, I believe it was Morgan Stanley and Goldman Sachs that came out. It was literally 2 and 3 months ago, 2 to 3 months ago, to have a higher 20% allocation or 15 and 20% allocation to gold. Correct me if I'm wrong, Michael.
I don't know. I didn't listen to the details of what they say. Okay.
Yeah, right. Yeah, usually it's crap. But
Yeah.
that being said, yeah, they came out with
Due
this thing
respect.
yeah, hey, with all due respect, with portfolio management. So it really fits really nicely into your thesis. Michael, again, let's get you here. We're talking about the miners here
Yeah.
and
Yeah. The
silver
top
and the
chart.
S&P.
Yeah, the top chart's the XAU index, which has been around since the 1980s. Gold and silver miners, okay, Philadelphia index. So it reflects the miners, and you'll notice going back to 2014 or so, well, you had a downtrend line. You hit one, two, three, four times, including back, several months ago, you hit it and backed off, and then you blew through it last month.
Yeah.
Okay. Well, again, here now it's echoing what gold says. Gold's beating the S&P, just broke out of a massive base. The miners say, hey, me too. Okay. Now, and then one below that is silver.
Yeah, let's talk about silver. It's been just ripping here. Yeah,
This is
talk about
last
that.
month's close now. We're higher than that now, by the way. Okay, but S&P versus silver, silver versus S&P, again in the bear trend from 2011 to 15, silver went down, relative performance went down. But as you can see, either side of about what is that level? 6.5, 6/10 of a percent. Uh, Price of silver expressed as a percent of the S&P. It went sideways basically since 2018, really.
Right.
Yeah,
Yeah.
it's a downtrend structure though. And when you broke through that last month, big time, um, and you're further up now, it says the same thing gold says versus S&P. Okay, so it's a chorus. It's not just gold, it's the gold silver miners. It's silver all saying, hey, thumbs down on the stock market. And it's just broken out. You don't break out like this and have a 3 month rally.
Yeah.
This is something that involves years, a couple of years at least. So the asset shift the earthquake has occurred, guys, but nobody's noticing it. All they're noticing is what RSI says on a weekly, you know.
Yeah.
Okay.
Yeah.
Anyway, that's
Yeah.
where we are. That's where we are.
Well, and to share that, I want to just give you a huge kudos here. Michael's been pounding the table every single time I've had him on, really in the past year, but actually just recently he talked about how he's just going to go and go really quick. And that's exactly what we happened. I would like to ask you, and again, this is my short-term hat, if you would. I see silver as, I'm looking at RSI, extremely overbought here.
Mhm.
Comment about that, if you
Yeah.
would.
Okay.
But I am looking to reallocate because I took some money off the table, but I am looking to reallocate if there is a pullback. Do you see anything
Our
shorter term?
assessment, no, no. Our assessment is that one, just like these charts have just broken out. And these charts don't break out and then sputter. These bases are too clear, too wide. It's not like I'm drawing a little 2 point trend line, subjectively. This is like 4 or 5 points spanning 11 years. And they all did it at once. So it's affirming, affirming, affirming. Something's going on here. Okay.
Yeah,
Now, most of the American public is not participating. We know that.
right.
They're very sub-level in terms of gold participation or monetary metals. That's going to wake up, especially when the stock market turns down in a way that hurts them. They notice. We argue technically that the stock market has been in a topping process since late last year, early this year. At that point, early this year, for example, S&P was just below 6,200. Okay. So
Mhm.
you drop, we got about 10% out above that high recently, and we're just sputtering up here for 3 months now, spinning wheels. Uh, our work on the S&P says this is virtually similar or the same as the 2000 dot-com, 2007 top. It was complex. It didn't just occur and then collapse. It was laborious. And in fact, each time they teased you with a new high after MSA declared, get out of this market.
Mhm.
Several months later, in both cases, it went up and made a new high, just enough so CNBC could report a new high.
Mhm.
And you could hear the cheering. It was a trap. Okay. Also, they're expecting what right now? Oh, the Fed's going to cut. Heck,
Right.
maybe they'll surprise us and give us a half point. Oh boy. Every time the Fed has started cutting in a series in a serious way, that marked the end of the bull market. In fact,
Right.
yeah, 2001, they started cutting in January. It was a handful of months off the high, not much price drop. They started cutting constantly. Market imploded. 2007, they printed the top tick almost.
Right.
Mid-September 7, they peaked like 3 weeks later in October, and that was it. Okay. So anybody cheering Fed rate cuts it hasn't done their homework.
Hmm.
It's not what you want because it says something. Anyway, but that's fuel for the monetary metals. They're
Yep.
going to pedal to the floor, you know. So anyway, all these pieces fit together. And that last one I mentioned, the T-bond thing. The T-bonds, something's wrong there. We all know fundamentally. Jamie
Hmm.
Dimon said you just can't keep doing this every decade type process where the government debt to GDP and all this. It can't just keep it pushed off. And he said this time it's probably going to be different. Well, I think it will be. And in fact, watch the T-bonds because they've been comatose for
Hmm.
about 3 years now. And right now, at 115 and a half, they're sort of in the lower quadrant of the price level of the last 3 years. So in other words, very anemic, yields very high. The
Hmm.
Fed rate cuts don't affect them. Watch out that beast because he drops another 3 points or so below where you're trading right now.
Yeah.
The March contract T-bond futures. You could get a rapid flush, meaning
Yep.
sharp spike. That's going to panic people because nobody expected it.
Yep.
And also it eliminates that quote alternative. Now you're
Yep.
down to one. So what I'm arguing here, wet bar of soap time. There's
Yep.
only one thing to grab. Okay. And I think it's beginning, and I think these spreads know it. And that's what they're
Yeah.
doing.
You brought up the T-bonds a couple of times, and to all my viewers and listeners, and to you, Michael, we had a saying when I was a very active trader trading a fund and running a lot of money is the pros watch the bonds, if you would.
Yeah.
So really keep an eye on the bonds. Bonds are what really almost everything almost just follows bonds, if you would. I mean, you'll have breakouts and that's, but where the big money is, they look at the bonds, bond yields specifically. So,
Yeah, well, the head of the president of the New York Fed, Williams, I think it was about 3 weeks ago, made a statement or a press conference, and I'm sure it was approved from higher ups in the Fed. Uh, the Federal Reserve is going to probably need to start buying T-bonds, he said, or buying bonds, quote
think about
unquote.
that.
And but not because they're in trouble. He didn't say that, of course, naturally. He said because of illiquidity. Oh, isn't that
Right.
nice? I'm so glad they're taking care. They're nervous. They're nervous as heck about government debt market. And we're not dealing with mortgages now, mom and pop mortgages. Okay. We're dealing with Japanese government bond implosion. Our government bonds in trouble. UK. This is too big. And when that event hits and they finally realize, central banks and the investment public, that, uh-oh, it's different this time. Something's
Yep.
really bad here. That market's bigger than the US stock market, US T-bonds.
Yep.
So you can't ignore it. Watch it.
Yep.
Very important.
Yep. Yeah, to all my viewers and listeners here, I'm looking at two different